Hey, Aaron Adams here with Infinity Investing. I wanted to take a few minutes today and share with you the 5 different criteria that I have used over the past 22 years to identify hot markets and to take advantage of them. Now, while teaching high school, I started out in Southern California, and as a high school teacher, stumbled into between the years of 2000 and 2004 until I started kind of divesting from that market, one of the hottest markets that we've seen in the last 50 years. I remember months in California where properties were appreciating 5% a month and over 100% a year. So that was obviously a red hot market. I got lucky. I happened to be living in Southern California. There was nothing deliberate about that. But shortly thereafter, I did really well in Las Vegas after the crash of 2008. We went into Florida and did really well in Orlando before all of Southeast Asia started buying all of Florida. We purchased homes back in California again after the crash. We went back after it had crashed and took advantage of that. We've been in the Midwest, Indianapolis, Charlotte, Kansas City, Dallas. Lately, we've been investing in Idaho, which has been red hot post-COVID. And so, I have a track record now of over 22 years of experience in identifying hot markets and working those markets. In the coming months, I'll be traveling to Alabama. There's some markets that I like there. There's some markets in Oklahoma that I really am interested in. Love Tennessee. So I'm always looking for new markets, and I want to share with you today the 5 criteria that I've used just briefly and that have really helped me. Now, obviously at Infinity Investing, we go into great detail and we really help you analyze markets. We share specifically what we're doing. But just to get you started today, just so that you can kind of determine if you're in a hot real estate market, we've put this together. So the first thing that I look at with markets is affordability. And what I mean by that is I look, California is red hot, but it doesn't mean it's good for investing. Hawaii's red hot because you can flip properties anywhere. And so if you can get a property for 60 cents on the dollar, it doesn't matter if it's San Francisco or Iowa, you're going to be able to make money on it. So that shouldn't be the criteria, because when you're looking at investing in real estate, you always have to think about the biggest drawback, which is liquidity, getting rid of it. And so I always look at home affordability and days on market to really identify if I can't sell the property for some reason. And that happened. I from 2000 to 2008, I was working in a real estate climate where it was always easy to sell properties. 2008 to 2013, 2014, it was sometimes difficult to get rid of a deal. Not a lot of buyers for that. And so having survived both kind of environments, I always start by looking at affordability. And what I compare is median home price to median income ratio. And based on what people are earning in that area and what the home prices are selling for, you have markets like Indianapolis that historically has always been very affordable for homeowners, very easy to buy a home. In fact, one of the reasons that tech has exploded in Indianapolis and why I've been in Indianapolis now for over 17 years is because big tech companies in very unaffordable San Francisco are opening offices in very affordable Indianapolis so that their employees can live there and have a real life and own a home. And so affordability is always something that I look at. Now, sometimes you can go overboard with affordability. I remember in 2010, 11, and 12, you could buy homes in Detroit for $1. But if you don't have the population base to support that, then what's the point of a free house? It's worthless. Which leads me to the next criteria point that I look at, which is population growth. Now, there's a lot of states right now that are growing in population, but I'm not as interested in them for investing. So, for example, boomers generally are retirees. That whole generation are starting to move down to the Sun Belt. So you see really strong population growth in Florida and in Texas and Arizona, Vegas. And for me, I guess if I were in home health care or if I was doing assisted living centers, I would be much more interested in kind of that Sun Belt segment. But for us, we're really looking at targeting millennials, Gen X, Gen Z. So I want to know where the 20 to 40-year-olds are moving and relocating and settling. That's the kind of population growth I'm looking at. So what I do is I look at a market, I look at the surrounding states, and I looking for that market, that metro, to outperform the states that directly kind of touch that market. And obviously, when you're looking at population growth and people relocate and move because of jobs and because of opportunity and because of the ability to have affordability, unemployment becomes a really important number. And not just the unemployment, I really look at the job market. What drives that job market? How diversified is that market? Is it, South Dakota of a few years ago was completely dependent on shale oil. And when that was no longer viable, it gutted that market. Or a market like Houston, where 80% of the commercial properties are somehow affiliated with oil and gas, which then could have a really huge detriment when gas prices and oil prices fall. Or even a Las Vegas that's really heavily dependent on tourism and casino gaming that during COVID, for example, when the casinos all closed down, that whole economy really suffered. And being a landlord in Vegas when the casinos aren't open, when the resorts aren't open, is not a good thing to be. So I want to see a really diversified economy, and I want to see 20 to 40-year-olds moving there for a specific purpose to take advantage and to start their lives and to live and work. I look at the state itself. Is it business friendly? When you think about it, states pass a lot of laws that have an impact on landlords. So property taxes come up. Landlord-tenant laws. Can you have rent restrictions? Can you evict your tenants? That was a big thing during COVID that came up. What do you need to get permits for? How much does an LLC cost? What does it cost to renew that annually? What is the state property? What are property tax rates? What are state income tax rates? And so some states like California are incredibly business unfriendly. States like New York are landlord-tenant unfriendly. States like Texas is interesting because they say, well, there's no state income tax. Well, yeah, but property tax is really high as an offset. Illinois state income tax and property tax are really high. And so I'm always looking at, is that state an area that's friendly to landlords and that's business friendly in general? Because when you buy a piece of property, when you buy a rental, you're not just buying a house, especially if you're not going to live in it, you're buying a business. And so if you're buying a business, you need to think of it like a business, and you're always going to be better off over time in markets in states that are business friendly. The final area that I kind of always touch on and look at is the city and the metro itself. And this is an interesting one because, let me kind of align this here for you. There we go. Get that a little more cleaner. A perfect example is Atlanta. Now, Atlanta has really good affordability, so it checks that box. It has strong population growth. It has relatively low unemployment. Georgia is business friendly. But Atlanta, the city itself, is broke. They have pension obligations that are really high. They borrowed a lot of money that they've been slow to pay off. And so when you look at tax dollars that come into a city and you look at the percentage of those tax dollars that are already pre-allocated to paying interest rates and paying back loans and paying pensions, those are firefighters you can't hire, police you can't hire, roads that don't get fixed. And so just like an individual, states and cities can be broke and have money or not have money and have good credit ratings even and not have good credit ratings. And as you pull these criteria together, certain markets will start to jump out at you. I love Harvard's Joint Center for Housing Studies website. It's a really good starting point for research. You don't have to have a registration. You don't have to sign up with them. You can just go read their research. That's a really good starting point. And then usually I move on to a whole list of Google searches about a market that kind of underline and support this. And so at our Infinity trainings, we spend a lot of time on markets that we're in, and we've been cutting edge in terms of where we've been investing for the past 22 years. And we also kind of share with you where some of these big Wall Street companies are investing as well. So if you'd like to get more information on this, if you'd like to know whether or not the market that you live in is a hot one, then click on the link below join us at one of our next free live events and get going with us at Infinity Investing. Appreciate you taking a few minutes to join me today on this topic, and I look forward to meeting you in person at one of our events very soon.